Hi, everybody. Chapter 7 is all about financial statement fraud. Since we are accountants in a Master's of Accounting program, we should be pretty familiar with these. So I'm going to run through this very quickly. So first off, let's think about the who, why, and how of financial statement fraud. So this is typically going to occur with people in the senior management position. Those are the people who have the most incentive. They're the people who have the most ability to manipulate. So this is where it's typically going to happen. But anyone who has access to the accounting records could theoretically manipulate them as well. So it could also be the mid or lower level. And then organized criminals who are looking to get a loan or do other bad stuff have also been known to manipulate financial statements. Why? They want to conceal the true business performance. They're underperforming. Their stock bonuses are tied to it, which gets us to some of these other ones. So they don't want people knowing what's truly going on. Maybe they have a big ego and they don't want people to know that their business is failing. So they want to preserve their personal status. Maybe their stock bonuses are tied to their performance. So they need to maintain that personal income or wealth. Any of those are reasons that they may manipulate the system. And then how are they doing it? So we have playing the accounting game, beating the accounting, playing the accounting system, beating the accounting system, or going outside the accounting system. So playing the accounting system means that everything that we have has actually occurred. So maybe we're dealing with like a timing difference. So the sale did occur, we're just not necessarily recording it in the right time. Beating the accounting system, however, is generating some fraudulent documents or sales to go around the accounting system. And then finally, going outside the accounting system means we're just making up the whole thing. There's nothing really legitimate about it. So those are the three different ways that we can do that. So let's start by first defining what is this thing called financial statement fraud. So I've given you the official definition, but basically we're using deliberate misstatements. So we're misstating our assets or our expenses or our revenues. We're misstating one of those fundamental financial statement accounts to deceive the users of those financial statements, particularly our investors or our creditors. The stock market, we want to make sure we maintain our stock prices. Whoever's using those financial statements, we're trying to trick them. This can happen in a number of ways. So we can falsify records, manipulate records, create new records that didn't really exist. We can have some omissions of events. So maybe we just don't record any of our expenses. We're just omitting them completely. We can misapply accounting principles. So when we talk about ways that we can do this, we'll talk about like our estimates for depreciation, and misapplying those principles is another fraudulent way that we can report our financial statements. And then finally, omission of disclosures. So a lot of times the disclosures in our accounting classes get overlooked. We think about the main statements, but we don't really spend time talking too much about those disclosures. But they are an important element of our financial statements. So if we omit something important or don't present the information appropriately, that's another form of financial statement fraud. So now we're going to talk about the various types of schemes. So the first one is we can have fictitious revenue. So recording of revenue that never actually happened. So we are recording fake sales. What are some red flags for this? We'll see growth in our profitability. We'll see those sales increasing at a rate higher than other companies in the same industry. So growth that's outside the industry norm. One common thing we'll see throughout each of these is we're going to have negative cash flow from operations despite reporting earnings and earnings growth. So if we're showing profit on that income statement, typically that should translate into income from operations. So when we have this disconnect between our statement of cash flows and our income statement, that's a red flag that something doesn't smell right. Because if you're showing profits on your income statement, you should also be showing positive cash flow from operations. Complex transactions, that's another one that we'll see quite often. Growth in the number of days sales and receivables. So how, the growth in that accounts receivable as a percentage of the days. Significant volume of sales to entities whose substance and ownership are not known. So we have these new customers that we've never sold to before, and we don't know, there's someone we've never heard of. So that could be another sign. And then finally, surge of sales in minority units or from corporate headquarters. So usually your corporate headquarters isn't one of your sales centers. But if we're seeing a bunch of sales from headquarters, that could be a sign of financial statement fraud. The second scheme we could have here is timing differences. So these are legitimate revenues or expenses, but we're just recording them in the incorrect period. So some examples could be like if we had a long-term contract that uses percentage of completion method to recognize revenues and expenses, we could manipulate those estimates so that we can record more of maybe that income now and push off it when we really haven't completed it, that percentage. Another example of this is channel stuffing. So getting customers to overbuy using deep discounts or extended credit terms to entice those customers to buy this year instead of waiting to buy next year. So that might not seem too bad, but if they're buying too much in one year, they may end up eventually returning that product, which would result in the lost sales for the next year, as well as increased returns in the next year. So it can have kind of a detrimental effect. Intentionally recording expenses in the wrong period. So we have a pile of accounts payables that we are just not putting in until we get to January 1st because we don't want them reported in December. That would be another example of a timing difference. That would be financial statement fraud. So some red flags again here. Again, rapid growth as compared to the industry, the negative cash flow from operations, showing earnings, significant, unusual, or highly complex transactions, especially those that happen close to your end, increase in gross margin compared to our peers, increase in the days sales receivable, and a decline in the days purchases and accounts payable. Again, if we're holding on to those accounts payable, we'll show a decline in that number because we're going to push those off into the next year. The third scheme that we're going to talk about is concealed liabilities and expenses. So there's three ways they can do this. They can either completely omit their liabilities and expenses, like what I was saying with the accounts payable, where we just stick them in a drawer or shred them and just don't record them at all. We could capitalize expenses that shouldn't typically be capitalized. They should be recorded as an expense rather than recorded as an asset. But if we can pull those expenses off, stick them on the balance sheet, that's going to make our profits look better. Failure to disclose warranty costs and liabilities. So here we would fail to properly record or present the expense that's associated with sales returns and customer allowances stemming from customer satisfaction. So that warranty liability is usually either going to be completely omitted or substantially underestimated, which is going to make that expense lower, and it's going to make our accounts receivable look higher. So that's something that we don't normally want to see. Red flags, again, we see that negative cash flow. That's one we'll see throughout all of these. When we have accounts such as revenues or assets, expenses that are based in significant estimates, so we can't really tie down to one exact number, but we're estimating what that could be. So this is like that warranty expense. We don't have a crystal ball that tells us exactly how much we're going to get. So we have to use estimates in order to get there. So using those estimates, having some subjective judgment or uncertainty about what that amount is going to be, and also difficult to corroborate, meaning, we have to take our client's word for it. We can't really get documentation as auditors on what it's going to be. So that's an area that's fraught and ripe for financial statement fraud. Again, a growth in gross margin. If we have the allowance for sales, warranty claims, all of those types of accounts that's shrinking is in terms of a percentage, that would indicate they're not recording as much as they should be. Reduction in the days sales purchases, we saw that one before, and reduced accounts payable while competitors are stretching out payments to vendors. So those are the red flags for thinking about concealed liabilities. The next one is improper disclosure. So like I said early in this video, we don't normally think about the notes to those financial statements, but they are very important. So some disclosures that we would typically see that would be improperly disclosed would be liability omissions. We would want to see discussion if we were omitting liabilities. Subsequent events. So let's say we had a subsequent event such as a fire in one of our warehouses that happened on January 3rd. That would be an event that really wouldn't impact the numbers on the financial statements at December 31st, but it would be important to users of those financial statements to know about. So we should have a note related to those subsequent events. So leaving off that note and not telling users of the financial statement that we had a fire that destroyed 50% of our inventory would be an improper disclosure. Management fraud, we are required to disclose any instance of management fraud. So leaving that disclosure off would be another example of an improper disclosure. Similarly, we're required to report related party transactions and any accounting changes. So going from one GAAP allowable method to another, or if there was some overarching change that happened without disclosing that information and stating how it impacts our financial statements, we would be improperly disclosed. So there's a whole host of red flags here. So domination of management or a small group with no compensating controls. That's one. Having an ineffective board of directors or audit committee. They're the ones who are going to be responsible for those financial statements and making sure that everything is reported the way that it should be. Ineffective communication of the entity's values or ethical standards. We see that growth and profitability again. The complex transactions happening again, the related party transactions. These are all indications that we could have some improper disclosures. We could also have an improper asset valuation. So this is typically going to fall into one of 4 different categories. So we have inventory valuation. So failing to write off our obsolete inventory or having fake inventory would show the inventory values would be improperly stated. We also could have an improper statement or valuation of accounts receivable. So accounts receivable is going to be affected through sales or inventory schemes that we've previously talked about. So if we have fictitious sales resulting in high accounts receivable, those receivables would eventually need to be written off. So that would be one instance, and then failing to write them off could be another way that accounts receivable could be manipulated. So these would indicate we'd have more accounts receivable than we really expect to collect. Business combinations. So when one company buys another company, they need to allocate their purchase price throughout the various business units, and misallocating those costs to allow the company to immediately write off more money than they really should is one improper asset valuation. And then finally, our long-term assets. So booking fictitious assets, so saying we purchased 5 trucks when we really don't have them, or misrepresenting our asset valuation by reporting assets at market value along with a gain instead of at cost. Improperly capitalizing our inventory and startup costs would also overinflate those long-term assets. So any of those means would impact this. Here again is our red flags. Again, we see that negative cash flow. We see significant declines in customer demands, accounts based on estimates. So a lot of the same things that we had seen previously are also showing up as red flags here. So how can we detect these? So we're talking about financial statement schemes. So how can we look at the financial statements, and what are some areas, or how can we look at these and say something doesn't seem quite right? So the first two, the vertical and the horizontal analysis, basically look at your financial statements in terms of a percentage. So in the vertical analysis, you're going to show each account on whichever statement, the income statement or the balance sheet, as a percentage of a key item in that statement. So for example, on our income statement, you'll show every account as a percentage of sales. And then on your balance sheet, you'll show every account as a percentage of assets. So if you see anything that looks out of line in those percentages, that's one way. The horizontal analysis is another percentage analysis, but in the horizontal analysis, we're looking at the percentage change of each account from one year to the next year, or one quarter to the next quarter. In the ratio analysis, your book gives you a whole host of ratios like the current, quick, turnovers, collection, inventory, turnover, average number of days in inventory. So it gives you a whole bunch, and it tells you how to calculate those. So doing that ratio analysis and looking for things that look out of line is another indicator. Analysis of our cash flow. So as I stated, in each of those red flags for the various schemes, having a growth in profits on our income statement and not also showing positive cash flows is a key indicator. So if we are showing profits, we should also have cash flow from operations. So if we don't, that is a big red flag. So analyzing that statement of cash flows. And then finally, looking at some non-financial numbers may also help in detecting of these schemes. So how can we deter financial statement fraud? So thinking back to our fraud triangle, we have to reduce the pressure, we have to reduce the opportunity, and we have to reduce the rationalization. So as far as the pressure, having effective board oversight, having that tone at the top, avoiding unachievable financial goals, avoid having incentives such as your bonuses and things tied to these unachievable or unrealistic goals can help to reduce that pressure. Reduce the opportunity. Opportunity comes from internal controls. So having accurate and complete internal accounting records, monitoring our business transactions, having good security systems, having strong internal controls. These are ways that we can reduce that opportunity. And then finally, reducing the rationalization. So promoting strong values, making sure that we're hiring good people, make sure that we have high integrity, that we value integrity. That would help to reduce those rationalization things. So that is it for chapter 12. Oh, sorry, not chapter 12, chapter 7. I look forward to seeing you next week for chapters 8 and 9.